I am Nathan Garcia, and today I'd like to help you with calculating your required minimum distributions. So in this video, you'll learn 5 steps to follow in order to calculate your required minimum distributions from your IRA or your 401k plan. Now, it's important to know that you will be following the guidelines that are put forth by the Internal Revenue Service, the IRS, and so there are tax consequences to taking your distributions or not taking them. This video is just for educational purposes and it shouldn't be intended as personal financial advice for you. However, when you follow along, you'll have a better understanding of what to expect when you do take out your required minimum distributions. And the reason this is so valuable for you is because if you don't take out your required minimum distribution in time, then the IRS will levy a 50% penalty on the amount that you didn't withdraw. This is one of the highest penalties that is applied by the IRS, and so you want to avoid it at all costs to ensure that your money goes to funding your lifestyle rather than paying for the government expenses. So with that, you'll want to grab a pen and paper and write these down. Now, the first thing that you'll have to do is to determine when you will have to start taking your required minimum distributions. The IRS requires that your RMDs begin the year following the year in which you turn age 70 and a half. Now, if you need to figure this out, it's really easy. All you do is calculate your age, add 6 months to that, and then the year following that is when you would need to take that required minimum distribution. If you have any questions, I'll put another video down below to help you out with this. So once you've figured out when your RMDs have to start, then you want to figure out the total value of your IRAs and your 401k accounts in the year before you are taking your required minimum distribution. So I'm recording this video in 2018. If I was calculating my 2018 RMD, I'd be looking at the total value of my investment accounts, my 401k and my IRA, in 2017. And once I have determined the total value of all of those accounts, now I can move on to the next step. Before we go there though, I want to share with you something that's very important. A lot of people ask if they have to take their required minimum distribution out of each account. And the answer is that you do have to take a required minimum distribution based on the total value of all of your accounts. However, the amount can be withdrawn from either an IRA or a 401k. So you have the option, you can take the total value out of one account, or you could take a smaller value out of multiple accounts. Remember, the IRS doesn't really care how they get their money. They just want to know that they're going to get their money. So once you have determined the total value of your accounts in the year prior to taking your RMD, then you can apply the distribution factor that's provided by the IRS. Now, this is a table that is going to determine how much money you have to withdraw from your IRA or your 401k and at which age. When you think about it from the IRS standpoint, they have allowed you to defer paying taxes on these investments that's in your IRA or your 401k. And so they'd like to receive payment on that, and that's why they mandate that you have to take out a certain percentage based on your age beginning after age 70 and a half. So once you figure out what that percentage is, you'll want to apply that to the total value of your 401k and your IRA balance in the year prior. And so that number, typically it begins at about 4%. It's not 4%, it's like 3.65%, but it's roughly 4% for example's sake. So if you had a portfolio that was $1 million, you should anticipate that you'll need to take out about $40,000 before December 31st of that filing year. Now, when you take out that distribution, remember, it can be from all of your accounts or from just one account. This is very important because oftentimes people will have investments that are illiquid in an IRA or a 401k, and they don't want to have to sell those assets in order to fulfill their required minimum distributions. You want to be knowledgeable of this up front, because if you are considering putting an annuity in your 401k or in your IRA, then you have to make sure that you're able to fulfill the required minimum distributions on the back end of it. So the second step is to determine what the withdrawal factor is, and then the third step is to actually go in and calculate the required minimum distribution. Now, oftentimes people have taken money out of their portfolio before they do their required minimum distribution calculation. And so once you know the value of your distribution, the required amount, then you can sum up any distributions that have already come out of your IRA. So if you have taken out, let's say that your required minimum distribution is $40,000 and you've already taken out $32,000 just to fund your lifestyle, then you would be required to take out $8,000 before the December 31st deadline. It's really important to take that distribution in time, because if you don't, remember that 50% penalty is going to apply on the amount that you should have taken out but didn't. So in our example where you're required to take out $40,000, you only took out $32,000. If you forgot, you were on vacation or whatever, and you didn't take that distribution, then you would have a 50% penalty on the $8,000 difference of the amount required and the amount that you actually took. So in that situation, you would have to pay a $4,000 penalty to the IRS. And it's just really silly to have that, because it's unnecessary. So it's great to calculate these required minimum distributions right around late October, early November, to make sure that everything is scheduled in time to ensure that you hit the deadline. And so that's what brings us to the fifth step for calculating your required minimum distribution, which is to make sure that you're taking the distribution before the 12/31 deadline. So make sure that you are actually taking the money out of your account before December 31st. This is so important if you use an investment manager or you use a big firm to help manage your investments, because with holidays and people being out of the office during that time, it's easy that the paperwork can build up and this can be overlooked. That's why I encourage you to begin planning for this in late October, early November, so that you have plenty of time to take the distribution before 12/31. So I hope that you found this video valuable with helping you take out your required minimum distributions. If you have any questions, then leave them in the comments below, or feel free to reach out to me. If you like this video, go ahead and click like and share it with a friend. I'd greatly appreciate it.